Okay, so you've given us quite a range of sources today. Looks like we're going everywhere from, the deep psychology of trading right through to big political what ifs and even specific currency calls. Quite the journey ahead.
Absolutely. And the mission really is to sift through all this complexity. We want to pull out the insights that you can actually use, sort of give you a shortcut to what's really driving things in finance today.
Mm.
It's about connecting the dots,
Yeah.
making sense of it all.
Connecting the dots sounds good. We need that right now. So the plan is start with trading psychology, which feels fundamental, then look at this hypothetical Fed situation, and then dive into the actual market analysis, currencies, stocks, the works. We're hunting for those nuggets of knowledge, those surprising facts that can really, well, empower you.
Yeah.
So let's kick things off with that core human element, fear. The sources pose this great question: gut fear versus head fear, which one's telling the truth?
Yeah, it's a really a critical distinction. The sources break it down clearly. You've got emotional fear first. That's the physical stuff. You feel it in your gut, your chest, maybe your solar plexus.
Right, that knot in your stomach feeling.
Exactly. And the key statistic here is that something like 80% of those gut feelings, that physical fear, are genuinely emotional warnings. And if you ignore them, they tend to hit your P&L, your profit and loss, pretty quickly. We're talking maybe within 15 minutes.
15 minutes.
15 minutes, wow. Yeah. It's like your body's early warning system going off. So the action plan there is quick unload the position, track down the reason you're feeling it, or, reanalyze things fast. Don't just sit there.
Okay, so act fast on the gut feeling. What about the other type? Cognitive fear.
Right. Cognitive fear, that shows up differently. Maybe pressure in your forehead or you find yourself clenching your jaw. It doesn't come from that raw physical response. It's built from information you've taken in or maybe just your own internal monologue, your self-talk.
Ah, so it's more mental chatter.
Pretty much. And often it's not actually grounded in immediate reality. It's your mind running scenarios, maybe overthinking. There's this compelling story in the sources about a trader who missed out on a $4 million gain.
4 million. Ouch.
Yeah, on an altcoin. And it was purely because of this cognitive fear, this head noise. So the action plan for this kind of fear is totally different. You pause, take a breath, exhale, analyze it. And actually, often the best thing to do is just ignore it.
That's a really powerful difference.
Yeah.
So it's not just that you feel fear, but where you feel it tells you whether to jump or to pause and think.
Precisely. Gut fear signals an immediate objective threat, usually. Act now. Head fear signals, well, noise. Pause, analyze, question it. Don't let it paralyze you unnecessarily.
It feels like understanding that difference is key to avoiding emotional decisions.
Absolutely. And this leads straight into something the sources call a golden rule for trading. It's simple but profound. Good ideas pay fast, and bad ones ask for time.
Good ideas pay fast. Huh. That sounds almost ruthless. Unpack that a bit. Why is that so powerful? It seems to challenge that idea of, being patient with a trade.
Well, it's powerful because it reflects a reality of markets. Profitable ideas, trades with real conviction behind them, often start working relatively quickly. They confirm your thesis. If a trade is just chopping around, going back to your entry, asking for more time, it's usually not a sign that a good idea is just, warming up.
It's a sign something's maybe wrong with the initial idea.
Often, yes. Or the timing's off, or the market's changed. The rule forces you to constantly seek conviction that pays, rather than clinging to hope that costs you time and capital. It keeps you dynamic, avoids those situations where you just let a bad position bleed because you hope it'll turn around.
Yeah, that makes sense. And this ties right into managing trades properly, especially when things don't go to plan. Like what happens when a trade almost hits your target, then pulls all the way back to your entry point? That's got to be frustrating.
Oh, it's incredibly frustrating. And it's exactly when your decision-making gets compromised the most. Emotions run high, judgment gets clouded. That's why pre-planning is vital. The sources suggest this framework, they call it the 3P framework.
The 3Ps. Okay, what are they?
Right. First P, profit-taking zone. Don't fixate on one exact price, like S&P at 6,322 on the dot. Think in zones. Maybe 6,322 down to 6,318. Price rarely hits a perfect level and reverses.
Yeah.
A zone gives you realistic flexibility.
Okay, a zone, not a point. Makes sense. Second P.
Second P is a time stop. This isn't about price, it's about duration. For example, if your trade hasn't really gone anywhere in, say, 48 hours, maybe it's time to tighten your stop loss considerably, or even just close it out. Why tie up capital in something that's not working?
Right, opportunity cost. And the third P.
This one's crucial. Reevaluate thesis. If price comes back to your entry after being close to your target, you absolutely have to stop and ask, is my original reason for putting on this trade still valid? Is the data, the policy backdrop, the volatility regime, whatever drove the trade, is it still intact?
And what if it's not?
If the thesis is broken, you close the trade, period. Doesn't matter if you're slightly up or down at that moment. The reason for the trade is gone, close it.
And if the thesis is still intact?
Well then, paradoxically, it might actually be an opportunity. If your original reasoning is still sound, the pullback to entry could be a chance to re-enter, add to the position, maybe even double down, because the potential you saw is still there.
So it forces a really disciplined check-in right when you're most likely to just react emotionally?
Exactly. It automates the decision based on logic, not fear or frustration. And there's another great rule tied to this. If price has had 2 full chances to accelerate and still doesn't, as soon you misprice the catalyst and flat is a position also.
Okay, say it again.
If price has had 2 full chances to accelerate and still doesn't, as soon you misprice the catalyst and flat is a position also. Basically, if the trade had its moments to really move and failed twice, just get out. Being flat, having no position, is also a valid position. Cut your losses, free up your mind.
That's super practical advice. Okay, so we've covered the internal, the psychology. Let's zoom out now to those big external forces. The sources explore this potential scenario. What if the Fed chair, Jay Powell, suddenly resigned? Say, today, July 16th, 2025. What happens?
Right, it's a fascinating what if. If Powell were to resign today, the immediate succession is actually automatic. The vice chair, Philip Jefferson, takes over as president. He's seen as moderately dovish, so that automatic handover would likely provide some initial continuity, maybe even calm the markets a bit at first.
So not immediate panic.
Probably not immediate panic, no, but you definitely see ripples in that first hour. The sources suggest 2-year Treasury yields would likely drop as markets anticipate maybe more rate cuts sooner. The dollar would probably soften against safe havens like the yen and the Swiss franc. You'd see volatility pick up, especially for emerging market currencies.
And stocks.
Equities might gap down, maybe around 2% is the estimate, but it's unlikely to be, structurally damaging in the long run. Remember, the Fed chair is influential, drives the narrative, but ultimately it's just one vote on the FOMC, the rate-setting committee.
That's a really important point. The chair leads, but it's a committee decision. So the market absorbs it, knowing the institution carries on.
Exactly. The market knows the framework is there. Plus, Jay Powell's official term ends next May anyway, so a departure isn't totally out of the blue, hypothetically. He could resign as chair, but stay on the board or leave entirely.
If there's any history to look back on here, has this happened before?
There is. The sources bring up Mariner Eccles back in 1948. He resigned as Fed chair after clashing with President Truman. Truman wanted low rates post-war. Eccles saw inflation rising and wanted to hike. Different context. Sure, dollar pegged to gold. Bretton Woods was active, but the parallels are striking.
Parallels like?
Huge government debt after a major event, then it was the war. Now it's COVID spending. Rising inflation concerns. Pressure on the central bank to keep borrowing costs low for the government. Eccles' resignation, interestingly, wasn't a massive shock because the tensions were known. It was kind of priced in.
So the suggestion is, if Powell were to leave under similar circumstances, maybe due to disagreements over debt or inflation,
the market dynamics could be fairly similar, as one source puts it. If it's anticipated or the reasons are understood, it might not have a huge impact. Now, who else could step in? Less likely names mentioned are Treasury Secretary Scott Bassin or former Governor Kevin Walsh. Or maybe just another current board nominee gets elevated.
And what if the market senses the next chair will be very different, say, much more dovish?
That's where it gets interesting. If the market sniffs out, as the source says, a very dovish successor, you'd likely see inflation expectations, what we call break-evens, get priced higher. And the yield curve could re-steepen.
Re-steepen.
Meaning shorter-term yields, like the 2-year, would fall, expecting rate cuts. But longer-term yields, like the 10-year, would actually rise, reflecting higher future inflation expectations and maybe less confidence in long-term control.
But wait, isn't the current administration focused on getting the 10-year yield down? They seem to see that as a measure of their success.
Precisely. That's the tension. A re-steepening curve driven by a dovish Fed expectation runs directly counter to the administration's goal of keeping long-term borrowing costs low. So you get this potential clash between the market narrative about Fed policy and the administration's stated strategy. It's quite a setup.
Okay, fascinating political dynamics. Let's bring it back to the markets right now. Starting with the U.S. dollar, what are the key forces acting on it?
The dollar's in a really interesting spot, tied closely to real yields and equities. The pattern observed is pretty clear. When real yields, that's nominal yields minus inflation expectations, go up and equities stall or fall, the dollar tends to go stratospheric.
And where are we now with those drivers?
Well, real yields are being stubborn. They've dipped since last November but haven't really collapsed. And inflation's actually picking up a bit, especially if you exclude autos. Goods inflation is expected to continue, partly due to tariffs. At the same time, you have that administration focus we just talked about, trying to keep the 10-year yield cap, maybe targeting 3.8% or 3.5%, down from around 4.47% now. The feeling is it probably won't get much above 4.6% or 4.8%.
So stubborn real yields, but maybe capped nominal yields. What does that imply?
It implies that if inflation picks up and nominal yields are held down, perhaps through this idea of shadow control.
Shadow control, like informal influence.
Kind of, yeah. Informal pressure or market operations to keep yields in a range without explicit policy shifts. If that happens, then real yields have to come down. The forecast mentioned is potentially as low as 1.8% or even 1.4%.
And equities, the S&P 500.
The signals from officials like Treasury Secretary Bassin back in Feb, April, May, and June suggest a strong desire to keep the economy humming and the S&P strong. So the outlook is for continued, maybe grinding, upward movement, price churning, a death grind higher, maybe like 2017, potentially revisiting the 60-75 level on the S&P.
Okay, so putting it all together for the dollar.
If equities grind higher and real yields fall significantly, those are both very negative conditions for the U.S. dollar, which leads to this core idea from the sources: a potential massive dollar short trade setting up over the next, say, 3 to 6 months. You could express that through pairs like USD-JPY, GBP-USD, and others.
A big dollar short. Okay,
Yeah.
let's talk about one of those pairs then. USD-JPY. The yen has been incredibly weak.
Incredibly weak. And the dynamics there, as we touched on, echo 1998, a big run-up, potentially followed by a blow-off top and reversal. The driver now is the carry trade.
Explain the carry trade again quickly.
Sure. Japanese interest rates are just vastly lower than everywhere else, so traders borrow yen very cheaply, sell it, and buy currencies with higher interest rates, like the pound or the dollar, and they profit from the interest rate difference, the carry. It fuels these huge trends, like GBP-JPY being up, 20,000 pips since last August?
20,000? That's insane.
It's almost felt like free money, though obviously it carries risk. And Japan's central bank recently stopped hiking rates, which just reinforces that yield gap.
So what could stop this yen weakness?
Two things mainly. One is that key date coming up, July 22nd, Japan's CPI release. If that inflation number comes in way hotter than expected, you could see a violent unwinding of these carry trades as people take profits fast. Expect massive swings if that happens.
And if CPI is just okay?
Then the trend probably continues. The forecast is for USD-JPY to potentially hit 152, another 300, 400 pips higher from here, though, never in a straight line. The other thing that could stop it is direct intervention by Japan's Ministry of Finance or some big unexpected global shock.
Okay, watching that July 22nd date. Now, you mentioned the London fix earlier. Can you explain that a bit more and any setups related to it?
Yeah, the London fix happens daily. It's a specific 1-hour window where major banks set benchmark currency rates for tons of global contracts and orders. Especially after big data prints like US CPI, the fix level itself can become a major supply-demand point, often driving moves of like 70 to 150 pips afterward.
But you said the recent one was lame.
Yeah, the assessment was that the market narrative around the last CPI was just really thin, conviction was low, maybe 65-70% confidence, instead of the 80-85% you'd want for a high probability trade off the fix. So not really worth playing. Although, interestingly, the DAX index fix worked perfectly on a 4-hour chart with its recent bearish feel.
Anything interesting right now with the fix?
Actually, yes. Gold. Right now, gold is trading below its 4-hour London fix opening price from earlier. Historically, about 90% of the time, price tends to revisit or get reabsorbed back to that opening level within the same 4-hour period or shortly after.
So the expectation is?
The expectation is for gold to ping it, as traders say, basically, revisit that fix opening price level, and then likely continue moving north. So it potentially sets up a bullish trade idea for gold this week, looking for that reversion first, then continuation.
Got it. We had a listener ask about the Swiss franc, CHF. Why isn't it used as a funding currency for carry trades like the yen, given its low rates?
That's a really good question. The dynamic for the Swiss franc shifted quite a bit, especially after the invasion of Ukraine. Apparently, Russia's ability to use CHF for, let's say, financial processing was significantly reduced.
Okay. And how did that change things?
It seems to have accelerated its evolution. Since around 2022, the CHF has become seen much more as a kind of European risk asset, but also a core safe haven. People aren't borrowing it cheaply to fund risk trades anymore. Instead, they're accumulating it for safety.
So its role has flipped.
In many ways, yes. Plus, there's this long-term, multi-decade uptrend since the 80s. It's increasingly perceived almost like Bitcoin, a store of value reflecting a certain mindset, a desire for stability, rather than just being driven by short-term interest rate differentials for carry trades.
Interesting shift. Briefly, what about the UK CPI that came out today?
Yeah, the UK CPI print today, July 16th, it'll feed into the Bank of England's thinking for their next rate cut decision. But honestly, no major fireworks were expected, and it seems unlikely to derail the BOE from its path towards cutting rates. Pretty much on track.
Okay. And finally, let's touch on Tesla. What's the read there using your framework?
Looking at Tesla through the lens of the 6-week cycle, that's the high and low established between the last two Fed meetings, May 7th and May 18th, the outlook is still generally bullish. The expectation is for bullish bets to pick up again after we get through the current earnings season. Liquidity looks okay.
Any key levels to watch?
Yeah, the analysis points to the 295 and 315 levels as potentially good areas to consider buying interest. The overall narrative seems set for continued bullishness.
And what would break that idea?
The invalidation point is pretty clear. A daily close below 273 would negate the whole bullish setup based on this cycle analysis. Need to watch that level.
Conviction level?
It's acknowledged as maybe slightly lower conviction than usual, just because the broader macro picture is getting, as the source says, very, very modern, meaning complex and maybe unpredictable. But the bias remains bullish for now.
What a tour. From the gut feelings of traders to Fed politics, global carry trades, and specific stock levels. We've really covered some ground, linking psychology, policy, and market action. It definitely gives you a different perspective on what's moving the needle.
Absolutely. And maybe a final thought to leave you with, building on that Fed discussion. Given those historical parallels we talked about and the administration's clear goals for things like the 10-year yield, how might the actual market narrative end up diverging from what policy intends? And more importantly, what kinds of opportunities or perhaps risks does that potential divergence create for you?
That is definitely something to mull over. A great question. Thanks so much for guiding us through this deep dive today.
Yeah.
And thank you for joining us. We hope this helps you connect the dots. Keep learning, and we'll see you next time.